welcome to the next panel. This is about digital lending. It's a very interesting topic, and I'm very excited to be with this, panel today. We've got a perfect blend of representation. Mr. Rajeev Ahuja, ED, RBL Bank. Mr. Ramgopal Subramani, Chief Strategy Officer from Perfios. And Mr. Sashank Rishyasringa, co-founder Axio Finance. My name is Hardik Shah. I'm a partner with BCG. Before we get started, just a quick, setup and a few, facts on the table to just set the context and the ground for the conversation, right? Borrowing the phrase, right? The banking industry is seeing a Cinderella moment. We are having, credit growth, which is, 9-year high. It's a broad spectrum. Retail lending is growing, corporate lending is growing, MSME, finance is growing, secured, unsecured. Every segment of the industry is growing. Industry NPAs have actually, now a legacy problem. Credit costs are as low as they've been in the last 5-6 years. But if you look at the customer pyramid, right, there's still a lot of under-penetration. If you look at, the SME, MSME market, the under-penetrated segments, there's a lot of, room for growth, lot of potential for lenders to actually serve this segment. And if you think about, the typical challenges that have been faced serving this segment, limited availability of, authentic data that's digitally available, high friction points in the journey. How do you have a model which is, cost effective and do it in a manner which serves a large fragmented base across the economy? And then how do you think about the technology standards, right? Is there a, common set of standards that supports this embedded finance and the lending? That was the situation if you asked 3-4 years back, but a lot of it is changing. There's an explosion of data and a variety of data sources that is available now for lenders. The bureau has been one of the key pillars of the success for retail lending. But if you now think about MSME lending, there's a lot of data on direct tax, on GST. There's a lot of data available on bank statement that can be digitally analyzed. And then a lot of unstructured data, social media, telco data, mobile scraping, a lot of it is available. It's about finding the right use cases and finding the right model to actually use this data. The other thing that's happening, and the public digital infrastructure has been the envy of the world, right? India's public digital infrastructure has been a really, well-articulated success story. There is the account aggregator framework that's coming up. There's the open framework that will, scale up very soon. It's about finding the right use cases and the right, levers to actually use this public digital infrastructure. And the last thing, if the lenders get this right, across the customer life cycle, there are a lot of use cases that can generate value and potential for the lenders. If you think about it, it's not only the credit decision that's about whether to give a loan to a borrower or not, but think about monitoring and portfolio quality. Think about the right pricing to the customer segment. Think about the right product, and can we spur innovation in terms of the product itself. So this is the context, and now I'd like to invite the panelists in the conversation, right? So, Mr. Ahuja, if I can start with you. You've been at the forefront of open banking and a lot of the partnerships and thinking about innovative financing. What has been your experience over the past 4-5 years?
So, thanks. I think the way we've approached it, and I'm saying it's the ideal way, is to first be humble to understand that the democratization of financial services has come and it's going to keep going. So approach the market with an open mindset. Look at partners. I think I'm glad we have one of our earliest partners sitting here and one as well. Because as banks, we're not going to be the only repositories of customer transactions data and interest. And then so what we did was we experimented a lot and built our tech openness, which, as you know, has to keep evolving. And I think 1 out of 5 has become large in scale for us in terms of the areas we chose. And now we have built a new business, which is credit cards, consumer finance related to that. But the most important learning Hardik, was that as large organizations, internally, how do you organize yourself from understanding what data you need? Just by saying there's a lot of data doesn't mean much, especially if you are coming into this with a certain legacy. How do your policies, processes change? Because some of these things are very unique, very niche. Third, what point of the value chain will use of data partnerships add the most value? Origination, risk assessment, monitoring, collection, or just end-to-end. And then gradually we converted our physical processes to as near digital native as we could. So today in our cards business, we are perhaps more digitally native than we are in other businesses. Okay, so but it's an evolution. I can't sit down and say, I want to dream of it tomorrow, it will happen. And so, learning from that, we've now launched a rural vehicle business about a year and a half ago, tractors, which seems a little odd sitting in this space where you can think consumer finance and supply chain. But actually, if you break down tractor finance journey end to end, you still need people, you still need collections, but today we can give an approval in a couple of hours and funding within the day. And that itself has made a huge difference. And now that operating model, end-to-end, including technology, including understanding, now we're going to launch a two-wheeler product and a used car product. Then hopefully our next thing will be, I would say, trade value chain as a larger play. Because again, I think as we were discussing that, we started consumer finance saying you are an employee of company X, so therefore your salary must be good. And then we'll embellish that with Perfios and other things. I think the trade value chain has similar, I would say, anchors on risk assessment and origination. So we believe that MSME finance, trade value chain, and some of the stuff which the government is doing, trends, eventually AA, Open, can make where consumer finances today, B2B finance, in the next 12-24 months. That's in a nutshell what we've done.
Very interesting. I think you mentioned, partnerships. If I can invite Ram, because he's been one partner that every lender has possibly tied up with. What's been your experience, Ram?
Thanks. It's good to be here. So obviously, Rajeev talked about partnerships. Our journey started with Sashank. We are back in 2014, June-July timeframe, right? So it's been a long journey of 8+ years. And we have been fortunate being in the right place at the right time we work with across the gamut, right? So even today we see a loan application for as low as 10,000 rupees coming as a request to something as high as probably 50 crores, right? So, and I keep talking about the fact is, people talk about scale in payment, right? And people think that the same scale holds true in lending. But lending is very different. It varies from product to product. It varies from institution to institution. I mean, we are the pioneer of bank statement analysis, right? Ideally, as a product company, and this is what many times our investor asks us, you built this product 8 years ago. Why are you investing more on it? Okay. But if I look at the fact is, we've probably gone from having some 100 attributes today to probably 1,000, 1,200 attributes. And the semantic of those things has been changing over time. As more and more cash flow comes in, initially it was digitization. I mean, I want a bank statement digitized. I want to understand every transaction meaning, right? Then people started saying, okay, I have this one, which is where it started with the offline or the back office operations, consuming it. Then obviously digital journeys, straight through process started building in. So which meant that what was the intelligence of a credit manager over ages, several decades of knowledge, right, had to be translated and codified. Now it is not just one single template. I mean, as simple as this, obviously the fact is, there are banks who say for a personal loan, I need 12 months of salary to occur. Now the gamut of customer varies. So someone who's working in Infosys probably gets his salary every month on first or second of the month, right? Whereas someone who's working on a small business might get 2 tranches of salary, like the American model, right? Now, how do you understand and identify that? Or there is, now there are 2 tranches, but then there might be a reimbursement, a salesperson, okay? And then you look at the business side of it, small businesses. How are they, who are their recurring customers, right? So what we have seen is we have seen this significant transformation in terms of data. I mean, technology enabling data, but intelligence being derived on it, and that is kind of evolved as product and process have become. So today, pretty much across the segment, a personal loan is on a digital journey, right, with a large amount of disbursal being done, all the way from a 10,000 to a 3 lakh kind of, right? Business loans, I mean, even I know for a fact there's a mudra loan like a Shishu, Tarun, Kishore. Okay, obviously Tarun and Kishore has a lot more complexities, but they are on a digital platform. So what I would say is, and obviously there are digitization is happening across the board. You have technology which is being deployed, right? In a customer journey, in an assisted journey, you have various forms of data which are being consumed. Okay, it could be in the process of onboarding. I mean, as simple as given a mobile number, can I find out if the person is roaming or not, right? Or pulling your data from an EPF or checking a license, right? Like as simple as a restaurant license, right? Or a pharmacy license. So that's there. And that is still an evolution. I think we have probably achieved certain aspects of digitization. But if I look at it, digitization translating into real digital business is a phase that we are entering into.
Interesting thought. I'll come back on that. Sashank, if I can get your views. Both Mr. Ahuja and Ram mentioned about the fact that you've been in this journey for a fairly long time, and it's been a remarkable story, right? Consumer-facing business, large portion unsecured, but you've had a really, remarkable story in terms of, managing the credit quality. Share us your experience in terms of how this has worked.
Thanks for having me, Hardik, and it's wonderful to share the stage with 2 of our oldest partners. I think one of the side effects of having been around for a while is we've evolved as the ecosystem has evolved around us, right? And if I just share a statistic with all of you, I think for the first 6 years of our business, we served about 600,000 customers. In the next 2 years, we went from 600,000 to 6 million customers, right? What changed? 2 big things that I will not take credit for at all. The first is the nature of the customer actually fundamentally altered, right? If you think of that sweet spot of people between the ages of 25 to 35 who are the target population for digital lending, that population really grew into the financial system in the last 5 years. Which means this is a post-Geo, post-UPI and COVID population whose purchasing behavior and habits have been shaped at the core by these 3 big events of the last 5 years, right? The second thing that has happened is the level of infrastructure that has reached maturity in India for digital lending, right? The ability to do KYC in a second, now pull data through RAM within seconds from a bank account through AA, right? UPI autopay for collections, which used to be the biggest headache of lenders like Rajeev and us, right? So all of these things cumulatively have transformed the game. And if you look at the outcome of this, it is significantly higher volumes, right? I think last month we added 500,000 new customers, right? Which is great, but as we all say, the business of lending is one of getting money back, not giving it out, right? So the true test is how many of these customers do we actually get money back from? And as you said, we've been on a journey where we've now gotten to a point where we have loss rates of around 1 to 1.5%, right? But what that has required, both for us and I would say the entire industry, is a complete change in how risk is managed. Because when you have, over 1 million dues on the 5th of the month, and you have to manage customers across 15,000 PIN codes, you cannot continue with the old models of human-driven underwriting, purely physical collections on the ground, right? But at the same time, you can't compromise on risk. So the exam question, I think for all of us in the last 3 years has been, how do you maintain credit quality during such explosive growth while transitioning your risk management models from an analog world to a digital world? And that has not been an easy journey. But I think it's one that's very, very exciting and is shaping the future of this industry, because the questions that we have to grapple with as financial institutions are, how do I move from people making decisions to machines making decisions? How do I move from people doing kind of, I would say, more kind of tactical work to credit managers monitoring portfolios and looking at early warning signals, right, on an aggregate basis? How do I move from a physical collector cutting a receipt to a physical collector who is, enabled with an app and able to do things very efficiently, and in some cases replacing the physical collector completely with technology, right? And so I think what we're going to see over the next 2 years, more than millions of customers, millions of loans, is actually an entirely new paradigm of how you manage risk in a digital world with data and decision science at its core.
Very interesting, and this brings me to the next segue. There's a lot of credit growth, and some say that this is going to be the lending is probably the same as it was 5 years ago, or before UPI, before all of this data was available. How do you see this changing? Is there really a fundamental difference in way underwriting is done today using all of this data? How ready is the industry in terms of using all of this data versus a lot of it driven by old policies, old models of assessing risk? Mr. Ahuja, if I can start with you.
So I think I'd say lending is still the same. You give money based on a certain assessment, and you got to recover money, and that's when you can hopefully pop the champagne. So I don't think that changes dramatically. But yes, the inputs which go into the assessment, origination. So again, look at the value chain. Who's your customer? 7-8 years ago, was a customer who was coming to the branch or through a partner. Today, a customer actually pulls your app if he or she wants it. I mean, if you got to chase that customer, then it's not an economic transaction. And then what data points do you use to assess, monitor, collect? Now, all of these can be made more productive using technology, data, as well as other forms of partnerships. And then you keep learning as you go along. I think the biggest challenge, as I mentioned in my preamble, and I think Sashank elaborated, is to see how your internal organization, internal capabilities, more than technology. So I know we're going to discuss technology, digital, ad infinitum, but it's more getting your internals right, and that's a learning curve. And it also means that some of the knowledge which people have gone through cycles is as important. So sometimes it's just very good to be a latecomer to the party. Okay, you can be a first mover and scale up. So unfortunately, if digital allows you to scale infinitely, it also can make mistakes at the same scale. So sometimes you can watch, wait, and then come late. And I think that's an internal conversation, business strategy, allocation of capital. What should your portfolio be? Because something or the other will keep knocking, off and on. But yes, I think the organizations who learn this quickly and make mistakes along the way, small mistakes hopefully, will be better suited probabilistically to deal with a very fast changing environment where you will have different forms of competition which can actually reorganize the entire production function very differently from yours, and your speed or lack thereof will become a huge issue. So we constantly battle. I would be loath to competing with Sashank on consumer finance because they do a damn good job. But they've been through the learning curve. And I think they would acknowledge that doing B2B finance and MSME finance is not their forte, which is why we've chosen the tougher aspects of tractor, two-wheeler, used cars. Because if I go and compete with him or 100 others on consumer finance, we will be the 110th player. So I think those are also things which you'll have to take into account internally. And wherever you can't do it yourself, in fact, I don't think there's anything which you can do entirely yourself. Partnership for knowledge, for understanding customer segment, for risk management, as well as for origination, is a very, very useful way of holding your investment tight and learning a lot in the process.
Interesting. Shashank, we were talking about sustainable and profitable lending, and you were sharing your experience in terms of how the product innovation can change the way lending can work, and how you've used risk assessment in a very different way. Any thoughts on how some of this can actually manifest into a better portfolio quality going forward?
It's a great question, Hardik, and I think this goes to Rajeev's point, right? That living through cycles is an extremely important experience for any lender. And I think collectively, in hindsight, perhaps we have been fortunate to have lived through a cycle over the last few years that the rest of the world, especially the developed world, is starting to go through now, right? And I think that presents an opportunity for the industry in India to actually scale retail credit in a much more responsible way than perhaps what we have seen in other economies, right? I think much as we talk about debt to GDP in India being a lot lower than, let's say, the US, I'm not convinced that copying the West, right, in terms of the speed of the scale up, the type of products, revolving credit, all of that is actually the right model for us, right? I think there's a lot of interesting learnings from businesses that have successfully scaled up credit to the bottom of the pyramid, like microfinance, on how you build credit products that are actually sustainable for the customer and hence sustainable to the lender, right? A big part of that is assessing leverage, right? I think probably the most important job that we as lenders have in this industry, and Ram is our sort of secret weapon in figuring this out because he is the gateway to the data, is when you think about the next 100 million customers, right, which is a nice thing to put on a slide, how do you actually figure out what is the right level of leverage that customer can bear? And that involves getting a very crisp understanding of income, of obligations, of expenses, not just at an individual level sometimes, but at the household level, and then tracking that dynamically over time so that at no point does, repeat business become a curse for the customer and eventually a curse for you as a lender. Right? And I think that journey of building credit products that are inherently responsible, right, that involve paying down debt rather than revolving debt within limits, that involve helping customers build a credit history, and most importantly that scale with the customer's capacity to pay. I think that entire opportunity is something where we can actually lead as a sector, and for the first time in a decade or more, we actually have the tools to do it, because you can get a real-time pulse on what the finances of a customer are, either in consumer or MSME, through the data that's now available through AA and all the sources that you mentioned. And I think it's a huge responsibility for us as an industry to figure out how credit policy, line management, collections, top-up policies, right, all of these things are designed with a view for long-term sustainability for this type of customer who is taking credit for the first time.
I think, interestingly, given where you start from, I think the organizational policies have been attuned to the digital products or the digital native, right? And Ram, you've seen actually both sides. The promise of, digital data and the underwriting can really change and make STP. But then you also, see the other side of lenders that are still, working on legacy policies. How has that, shaped up, and what is your experience, or what is your, in some sense, suggestion for the lenders in terms of shaping this?
See, okay, so I think, end of the day, data is just data. And what we also realize is over a period of time, right? It is not that the data is going to be complete for all segments, right? I mean, if I look at the fact is just a simple data point. If I looked at customers, a Kirana store, or even let's say someone who's earning something like 20,000-30,000 rupees per month salary, right? 5 years or 6 years ago, he was cash heavy. So his bank statement would have had at the best 10 transactions, 5 transactions, 10 transactions. Now with UPI, your transactions are anywhere between 60 to 70 transactions per month. Now if you're a small kirana store, you probably have a very thick bank statement, which you used to think about a business with maybe, let's say, 30 to 50 crores, right? So, which is richness of data, which comes into play. Okay. Now, we have seen journeys where people have built complete digital decision, but then we've also seen as they've built digital decisions, we've also seen digital frauds, right? Syndicated frauds, point of sale acquisition frauds. And these are things which you keep on building to solve for. And the companies who are in the process of adopting technology, I would say that first part is, see, technology and data are enablers. And please be aware that you will not get 100% coverage. I mean, as simple as this is, even the fact is, EPFO, given a mobile number, getting a UAN data and getting a EPFO data is probably 40% coverage today, but it is increasing. It was probably 5% 3 years ago. So if you look at the coverage, that coverage is there. So the data journey is an evolution. So as you think about your strategy, the strategy has to be that some of these things will evolve over a period of time. It is not going to be a binary 0 or 1. I'll do something if I have everything, or I will not do anything. I think that is one of the biggest challenge which happens, is because that's a part. Second is, there are newer forms of data. I mean, as simple as, I know the fact is GST has been there for now almost 5+ years. Okay, and the fact is your e-invoices come in. I was talking to someone said that in your chart, the micro segment should actually become data rich in 12 months time frame, right? Which was non-existent, right? But that's still data. How do you derive information? I mean, I know fact is one of the public sector banks, we worked with them for the last 2 years on their personal loan, right? The GMIT was talking about the fact is, recently I met him and he said, after almost a year of digital applications being processed, today our systems are predictable, stable, and we're able to do even NTB, new to bank segment. So which means that there's a lot of resilience in the process. And as you look at this, I mean, I'll just give another example, right? One of the things which we discovered 3 years ago, public sector banks have a lot of government employees, right? And the employer name is, let's say CRPF is Central Reserve Police Force, but the narration in the bank statement is CRP. In some cases, it is CRPF-DT in some cases. Okay, now a human seeing this has that experience, they have understood this part of it. A system is seen for the first time, and someone said, okay, this is not working. Your process is useless, it's not working. Okay, but there is a learning. I think there is, what is a major takeaway for us has been the fact that this is still an evolution. There will be learnings. So it is also some things have to be experimented. I mean, it cannot be a big bang that I will have every application go through the process, right? You look at segments, you start with a branch or you start with the area, build out your CUG, right? From CUG to production is something where you target a set. I mean, you will find teething problem. The first 100, the first 1,000, the first 10,000. And then you will hit that inflection point maybe at 1 lakh or 3 lakhs, where the system is a lot more predictable and this thing. But it is also, what you have seen is like, I mean, as simple as 60% of narrations are UPI transactions, which is not even thought of, right? So you'll have newer kind of challenges coming in. Newer forms of data are there. Like for small businesses, the amount of license information which is available publicly today did not exist 5 years ago. So I think it has to be a journey and requires both patience and resilience.
if I can just stay with you, and one interesting analogy you had discussed when we were chatting earlier was the whole railroads have changed. The new public railroads, the Open framework, etc. have come in. We need new fuel, new technology to actually run on those railroads. How ready do you think the lenders are to actually run on those new public railroads?
See, if I look at the fact is, if I look at the GEM, right, I think roughly around 10 finance banks are on the platform, right? There are probably 4 of them who are already lending, as in rails, right? Like you said, the word is railroad, right? The tracks have been built, okay. Some of the engines, okay, it is probably a steam locomotive train which is running, right? But then you don't have the bullet train running on it, right? The passenger who's coming on this is very different. I mean, just the part on GEM, we see with quite a few lenders that we are powering for them to participate. We see around 30,000 applications on an average per month. 50% of it is a purchase order, which is less than 15,000 rupees. None of the bank's policies are geared to lend to them. But then the objective is your SME and micro, right? You might, obviously, if you're a public sector bank, then you're mandated to participate, right? And then lend for them. So, how do you, if you want to make the railroads to be effective, think of it as a distribution channel, it's a new distribution channel. Your policies have to change. The criteria might be different. It might be, thresholds might be different. So if that doesn't change this thing, in the account aggregator, it was a stupendous job to have all banks live on by 31st July. I know we had to burn midnight candles in many banks to get them up and running. But today, over the last 12 months, today we are seeing almost 1 million requests. It is data, right? And SEBI has given the mandate, so we expect the capital market starting to come in. But that is again data, right? So the rails are this thing, like what you had in your slide. I think every aspect of the life cycle, there are infrastructures. Like the way the Aadhaar took a long time to become acceptable, right? Quality of data and all those things. UPI has become. I think in the same manner, OCEN or even ONDC will also take time and evolve. And here again, these are probably candidates for experimentation. And if you think about your business is being structured slightly different as a digital unit, a DBU, which again is a mandate, right? Some point of time. Experiment on those one would be my take.
Very interesting. So, Ahuja, I think on the one side there is this whole promise of OCEN and AA, and a lot of hopes being pinned on it, right? I think on the MSME side, you had mentioned there's a lot of other things that are actually out there, co-lending, trades, a lot of these enablers. How do you see those platforms evolving, and what's the traction that you're seeing over there?
So I think we have obviously a deep belief in the open platforms, eventually also creating scale and adoption. But the short-term opportunity is to narrow frame your problem statement or the opportunity. So we've been working with a couple of threads. We accidentally discovered it, that this is an opportunity. Many banks use this as a treasury activity. We said it's actually an opportunity to discover MSMEs which are bankable. So, the recourse is to the buyer, which is great, but can I get conduct and purchase information or sales information for the MSME to develop my understanding? And usually these exchanges have enough demographics on the MSME, enough history of defaults, payments, not quality yet. So can we build an MSME business leveraging this? I'll still need people, but can we sharpen our prospecting and risk assessment? And then can we start with small tickets, let's say a few lakhs, and then maybe 1 crore. So this changes the whole way we originate. Okay, I think this is there. There are a lot of private, fintechs who are taking large, complex, layered business verticals. Okay, and building what I would say is a very different layer of automation But more than automation is aggregation of the end retailer, which is always a challenge for a challenger brand, because the large brands have built it over 30, 50 years and their products sell. But a challenger brand needs to buy distribution. So, this was an interesting thing where can we work with them? They can bring these customers and the anchoring of the major, challenger brand to build retail finance. So I think there are many ways to, I would say, sharpen your lenses, your perspective, so that you're not just waiting for the larger platforms to scale up, but you continue learning and doing business. And these are very nifty ways of doing it. I mean, it's not a tedious way. And actually you end up learning hell of a lot. And meanwhile you work in parallel on GEM, you work parallel on ONDC, Oaken, and these will eventually come up. So I think, as I mentioned, our new foray of development with a digital mindset. I mean, I just want to be clear that nothing in life is end-to-end, digital. I mean, even when your Uber doesn't come because there's a physical person and a traffic jam, you still have to call the guy, or the guy calls you. So in lending, I think, unless it's the third, fourth time, you better be able to visualize the borrower. And actually, sometimes putting a physical signature is better than just a digital signature, but I'm a little old-fashioned there. But I think there's lots of opportunities to improve the economics and your reach. I think this is where I think India is exciting, because outside of the large platforms, there are also these very specific platforms which are there. And if you can collaborate with them and work with them, I think we'll find many successes along the way.
I think one of the things that, for making these platforms successful is also just tailoring the product, right? Sashank, you had mentioned about, almost creating, you have been the pioneers of it, right? Almost creating a category of new product of checkout financing, right? How do you see that journey evolving as these platforms come up, as these, public railroads come up?
I think probably the single biggest opportunity we have ahead of us today is what is loosely called embedded finance. But I think essentially is about weaving credit into this new structures of commerce that are coming out in the country, right? And it's not a new idea, it's a very obvious one, but it was hard to do in the analog world. People did it, for example, right? You have NBFCs that had a person in the store when financing. You had supply chain financing partnerships where literally invoices would pass around in envelopes to factoring companies, right? But it was hard to create credit as a product that could be woven into a commercial transaction, right? That was hard. It still is. I mean, if you want a home loan today, it's not really synchronous with buying a house, right? I mean, I took a car loan like a few months ago, and it took more time to get the car loan than to buy the car, right? But all of that is rapidly changing because rails like Oaken, like ONDC and others are actually creating opportunities to weave and invent new credit products or other new versions of credit products that can be native to the commerce journey, right? So you're on a platform like an Amazon, you want to finance a purchase, you click and you can buy it on 3 installments, what we do, right? You're on a B2B marketplace, you're looking for supplier credit, within a few clicks you can access it for that purchase that you're making, right? Similarly with a distribution value chain, let's say in the FMCG space, right? And I think these kind of products that are digitally native, that are tied to specific use cases of commerce, will be the future because they're more efficient, right? They're actually like very low CAC products because they're pull based versus the legions of people who call you every day trying to sell a personal loan, right? Which we all do, by the way, so not pointing fingers at anyone. They are lower risk because they're contextual, right? And they're tied to specific use cases. And over time, they're a lot more scalable because you're actually tying portfolio quality to the growth of commerce directly, right? And so if we believe and underwrite India's growth story and we underwrite that story in specific sectors, we can tightly link our portfolio quality to those sectors by creating products like this. So I definitely feel like this is the future and we're literally like at the tip of the iceberg in terms of seeing the full potential of embedded finance in this country.
I'm conscious of time, so just one last question for all of you, right? There's a lot of, enabling regulation, enabling infrastructure that's coming up. If you were to pick, one or two items on the wish list that you would want the regulator or the government to actually push through, what would that be? I'll just go,
Sure. I think the single biggest challenge for the next few years in scaling up digital lending is going to be liquidity. Right? I think we've solved technology to a large extent. I think we're on our way to solving risk in a digital environment. But at the end of the day, the fundamental challenge is all of kind of frontier credit over the next few years is going to be triple B risk. Right? And we still have a capital markets that only wants A quality. And part of that problem is information asymmetry. Part of that problem is that we actually have one of the least developed capital markets in the world from a debt in terms of securitization. So I think the biggest thing on my wish list would be actually creating a more robust debt capital markets framework and infrastructure that can make data on the performance of underlying loan pools a lot more transparent, so we can attract more participants, banks and non-banks, into those markets. Right? I think bank, NBFC, bank, fintech partnerships have done a great job over the last few years. But we need a fundamental expansion of the risk-carrying capacity of our capital markets if we're actually going to target those next 100, 200, 300 million customers.
Mr. Ahuja,
So a couple of things. I think we've all made great progress on the consumer side, the individual side, Bureau, Perfios, etc. I think I would love to see a move towards an MSME KYC or Know Your Business as much as centrally available. I know it's not easy, but so wasn't consumer, easy 10, 15 years ago. Because I think if you do that, then the costs of knowing your MSME or discovering them comes down, which is why we like Treads, because that discovery process has happened. The demographics is there. The second thing is that in the same MSME financing, if we keep publishing all invoices, all delivered goods somehow digitally, again, and not just the ones which have been financed, we can build more, I would say, informed models of risk assessment. And I think we are working, we're talking to the authorities, but specifically for MSME, if we have to make that as a big success, because I think that's the biggest credit-starved opportunity, which has a lot of, I would say, intermediation costs embedded, which is still not fully rationalized. So if we can work on that as a collective, I think those will be very useful.
See, as a tech fin, right? So one is obviously there's enough technology, but then I think there definitely is a need for, I would say, certain adoption of policies around technologies, right? I know there's cloud is there and some of the newer things are coming in. But more importantly, I would say that especially if you look at the whole micro segment, right? And which is where most of the benefit of scale of technology and all these rails which have been built in. Getting certain policies, right, in terms of risk management and other things, right, would be something which will really help. And to an extent I'll be also, since it's wishful thinking, right, and if there are some kinds of credit guarantees being built into some of these programs, the ability to take risk will probably increase. And then you'll be able to experiment and test out, saying that this is what. I think that is how we will be able to really achieve the dream. Because I think to a large extent, retail is kind of solved for. And MSME is something there. But MSME again is probably, a lot of these things is probably in the mid segment. But I think the long tail, which is where really the support is needed, requires a kind of intervention.
Quite an interesting wish list. The one thing, given we have time, right, I think the fact that we are here 2 years later, if any questions from the audience for the panelist, it's been quite an interesting discussion.
Corporate organization which has setups in various states. what would be one thing? So trades, Mr. Ahuja, you have really talked about and how that has made discovery easy. About 30,000 MSMEs which we there on 3 platforms combined. And the information that they have, I think, is very, very rich on these 30,000. But still, there's just 30,000, there's 65 million number that we all quote. Where do you see this going, wherein we can go to the next, because it's only 1 million which is actually credit worthy at the point of time. Where do you think that next, I would say at least 10 million out of that 65 million which can actually become credit worthy? Because trades with its limitations has done well, but because the way it's structured, where do you think it can go? What is that one thing? All of you gave a wish list, but one thing which really can make that change. For consumers, it's become easy. We don't have to think about it. But opening a current account itself is not easy, right? Whether it's cross-border finance, whether it's domestic trade finance. So one thing which really can make it easier. Difficult question, but yeah. But
no, I mean, which is why that was my wish list. So I'll only say that I think we're in the early days of MSME financing. And I will also acknowledge that there is no, sorry to use Brahmastra for that. I mean, it took a while to get to Aadhaar and get to some commonality on consumer finance. By the way, a lot of consumer finance still happens the old-fashioned way. I mean, it's just that we don't hear about it in the press as much. I think MSME finance will take a little while. But I think if the enablers on common KYC increasingly, publishing information about MSME purchases, sales electronically. See, ultimately, what's the challenge? I mean, today, if you go to a bank branch, local bank branch, they do MSME financing. They do MSME financing next door. They go and see the MSME's business. They make an assessment, literally kicking the tires. Now, that limits the amount of financing you do, the number of suppliers of financing there can be. But if you were able to increasingly digitize some of the common information about them, I mean, not many of them are in the GST fold as well. But I'm saying, even if we go down that path from, 1 million to 2 million to 3 million, but make available this information, there are costs of reaching out. We don't have to put the proverbial branch with 10 people, undergo a 50% HR churn, and then, discover that we can only do this much. I think those are the limitations. So I think this will progress. We've taken the view that go by the trade value chain, because typically MSMEs either are local MSMEs which are really serving the local community, or they are selling to a little larger company which is selling to a larger company. So this is old-fashioned banking, cluster banking. You go into an auto cluster, you put your branch there, or a pharma cluster. It's the same concept, except that it can be done at scale, and you can have many providers, so your costs of financing can come down over time. So I think these are some of the things we will obviously advocate. We are advocating, but yeah, it's a tough one. So many forms of go-to-market will have to work in parallel. I don't think we can just wait for a one size fits all. It'll never happen though.
Just one last question.
Actually, there are millions of individuals who are categorized as no income proof and new to credit, but technically they are earning a livelihood. But do not really qualify as a typical bank customer, and Perfios may not necessarily be able to get data on them. These guys are perennially credit starved to manage their affairs. So how will the tech-enabled lending ecosystem step up to meet their requirements?
It's a great question, right? And if you just look back at the last 100 years of lending, right? I think there have been broadly 3 models, right? There has been asset-backed, which is where you can give the largest amount of exposure with the largest amount of information available. Then there has been credit score-based lending, where you can give sort of a medium amount of exposure and with a medium amount of information. And then there has been relationship-based lending, right? Where you give very small amounts with very little information available. And the reality is, if you look at the next 100, 200 million customers in India who are actually NTC, right, -1 on bureau, the only way they're going to be cracked is through the relationship building model, right? By starting out with creating products that are tied to use cases, where the initial line size or exposure is very small. These customers get a chance to prove their repayment track record by, paying down 3 EMIs, 4 EMIs, and then they're able to then steadily work their way to larger limits, thanks to the track record that they've built on you as a lender, right? This is what Capital One, for example, called a low and grow approach in the US, and what I think the rural segment has done very well in India. And the reality is, this is the only way these customers are going to get unlocked. Now, where tech becomes interesting is tech actually crashes the cost of doing this kind of low and grow underwriting. Because suddenly giving like 1,000 rupee loan becomes economical, and then running a iterative process where you can keep upgrading that 1,000 rupee limit based on repayment history becomes something that you can automate. And then you can then run this low and grow model on millions of customers, so long as you have the right level of human oversight and governance, right? And so I actually believe that this model of kind of low and grow enabled at small ticket sizes enabled through tech is going to be the only way that you're going to crack the next 50, 100, 200 million NTC customers at scale. And yes, it's going to involve a learning curve, and you are going to have a situation where new customers have a higher credit cost than existing customers. But over time, as this flywheel speeds up, you're going to have a model that can actually, in some ways, build a credit history for these customers so that they can start to unlock larger and larger exposures over a long period of time. So you start with 1,000 rupee loan, but maybe end up with a home loan in 10 years.
Good morning. I am KK Gupta here from the Resurgent India. I think what you are talking about, the digital lending, it will play a very important role for a consumer who was outside of the financial inclusion also. So what do you feel that? What are the risk factor? Why financing the bank or why the NBFC? How you can mitigate the risk factor? That is most important issue. Have any view on that?
Sorry, can you repeat the question?
I want there is a risk factor will be there for digital lending. Have any view on the, you can say, for risk factor? How you mitigate the risk factor?
The risk factors on digital lending.
On digital lending.
See, I think the risk factor in digital lending can be actually mitigated by looking at more and more sources of data, right? I mean, if I take an example in the traditional bank, right? You had a Cat A, Cat B, Cat C company, right? On a Cat A company, if he's just on his employee of a Cat A company, uses to the salary slip and because he had an existing banking relationship with you. But as you went to Cat B or Cat C, right, you had more and more data points that you used. So every stage of the part is just to give the part, right? I mean, your address from Aadhaar versus your address from the bank statement, if they don't match, right? If you are using a mobile, you're using mobile data to verify, is he roaming? Okay, right? And then if you look at the information from any other source, like proof of address, LPG address, right? That can become. So in digital, there's also this whole challenge here of experience. People say, I want least amount of data to be taken as input, least friction in the journey. Okay, ideally I want to lend to a customer without asking him anything. That's a myth, right? If you want to manage risk or fraud, you have to look at triangulating as many sources of data as possible. I mean, just the combination of a bank statement, bureau plus salary slip, or an income tax return, or for a business the ITRV or the ITR form plus the GST plus the bank statement, all of this requires customer engagement, requires data to be asked for, requires more clicks. Okay. Now, if you accept that that is a fraud that you want to manage, then I would say that is necessary. Because you can easily triangulate, then there are behavioral aspects. I mean, as simple as, because you have more data now, you can look at, I mean, as simple as this, we have seen cases where people keep depositing cash regularly, right? and then it is taken out. It is rotation. Now at scale, technology can enable you to identify those kind of behaviors, right? Party name, basically between your party name, which may be either in the financial statement and the income of MSME, or it might be GST, whether if a record does not exist of any payment received at all, right? This is part of it. Or the fact is like a voter ID being used as an identifier to identify whether the person is, two different businesses are operating out of the same residence. Okay. So I think there are enough forms of data available, right? But the part is you have to an extent reimagine this part of it, which is where the fraud is. Because we have seen, again, on the consumer side, we have seen fraud in the last 2-3 years, which is about policies which were very thin. So that's the part.
Major issue is for
Sir, I
microfinance.
will
I'm
give
talking
you
about
a-
the microfinance.
I will give you an add-on to Ram with a less sophisticated and more blunt answer, which is the two guardrails you need in digital lending are compliance and collections. Right? Whatever you do, technology has to meet the same compliance norms as the offline world. It's very tempting to take shortcuts, but that's a surefire way to hell. And in India, without collections, you can do all the data-driven underwriting in the world, but if you don't have strong collections, you're going to lose your shirt. These two things alone will save you in the scale-up.
On that note, I'm conscious of time. Thank you to all our panelists. This has been a very engaging discussion. I'm sure if we continue for an hour also, there will be more questions. So thank you so much.